Welcome to the Deep Dive. Today, we are buckling up for a focused look at the electric vehicle sector. And specifically, we're talking about Lucid Motors, ticker LCID. Following their recent Q3 financial reporting, what our sources are showing is, well, it's a classic case of a company on two completely opposite streaks.
And that paradox is really the core of what we need to get into today. The mission for you is to get past the headlines, to really dissect these key numbers.
Right.
And to understand the critical implications of that massive financial lifeline they've just secured.
From the Saudi Public Investment Fund, we'll also need to get into their new partnerships, specifically with Uber and Nuro.
Exactly.
So let's start with that paradox. The good streak, and it is genuinely impressive, is that Lucid has posted 7 consecutive quarters of record deliveries.
7 quarters.
When you see that kind of growth, you just assume the whole machine is humming along perfectly, right?
You'd think so. I mean, operationally, they are definitely getting better at the simple act of building cars, but that's where it gets complicated.
Because that achievement is just completely wiped out by the bad streak.
Completely. The automaker has now fallen short of Wall Street earnings estimates for 2 quarters in a row. They're delivering more cars, yes, but the financials just aren't keeping up.
Which is a huge red flag for operational costs.
A massive one. It screams market resistance and high expenses.
Okay, so let's jump right into that Q3 financial reality, because the numbers here are pretty stark. We're looking at the LSEG data for the Wall Street consensus.
Right.
Lucid's reported revenue was $336.6 million. I mean, that sounds like a lot of money.
But it missed the mark. The estimate was closer to $379 million. So they missed on sales.
And the bottom line miss was just as bad. The adjusted loss per share was, what, $2.65?
It was. And analysts were hoping for a loss of around $2.27. So, a miss on the top line and a miss on the bottom line. It reinforces that whole narrative.
That they can build the cars, but they can't do it profitably.
It's not yet. Not even close.
But the real eye-opener, and honestly the figure that just defines their entire struggle right now, has to be the gross margin.
Oh, the gross margin.
The figure was a staggering negative 9,790%. I mean, that number is so far outside the norm, it's almost funny.
It's catastrophic. If there's one number for you to remember from this whole report, it's that one.
If I saw that on my personal balance sheet, I think I would just, walk away. How do they even begin to justify that?
Well, what it tells us is that for every single dollar of revenue Lucid brings in, they're losing almost $100 just to make the car.
The $100.
In manufacturing, materials, labor, they're making a luxury product at a cost efficiency that's, well, it's worse than almost any other sector. It just shows the insane expense of starting a premium EV brand from scratch.
And that's the internal inefficiency. But external factors are making it even harder, especially on the demand side. Our sources keep pointing to this whipsaw effect.
Exactly. The big external challenge here was the Trump administration's removal of that $7,500 U.S. federal EV tax credit back in September.
Which hits a luxury brand like Lucid especially hard.
It does. For a high-end buyer, that $7,500 can be the deciding factor between a Lucid Air and, say, a comparable Mercedes or BMW.
So it's not just a discount, it's a direct market-shaping mechanism.
Right. It's called a whipsaw because demand just snaps back and forth when these rules change. You pull that credit, and you get immediate price paralysis.
People just wait.
Buyers who are ready to go suddenly hit the brakes. They're waiting to see if the policy changes again, or maybe if Lucid will drop its prices to compensate. It creates this huge volatility.
And all that volatility leads us right to the big question of financing. I mean, how does a company survive a cash burn like that?
Well, that's where their largest shareholder, Saudi Arabia's Public Investment Fund, or PIF, comes in. They've stepped up again as the primary lifeline.
The PIF is basically the only reason Lucid still has a future, isn't it?
Pretty much. They agreed to increase a term loan credit facility from $750 million up to about $2 billion.
$2 billion.
It's a massive injection. And it really just underscores how strategically important this American EV company is to the Saudis' long-term economic plans.
So what's their overall liquidity look like now?
They ended Q3 with about $5.5 billion in total liquidity. That includes around $1.6 billion in actual cash and equivalents. So they have a pretty significant runway.
And that PIF deal extends the runway to 2027. So if they have that much time and one giant committed backer, isn't the real risk for a shareholder just endless dilution.
That's a really important distinction, yes. For the immediate future, dilution is the main concern for you as an investor.
The PIF's backing buys them time, maybe into the first half of 2027, which is crucial.
It's crucial time to solve that production puzzle. But this capital raise also signals they're expecting to need more down the road. And every time they tap the PIF or issue more shares, current shareholders see their stake get smaller.
And that risk of the PIF just pulling the plug, while maybe it's remote today, it's still sort of the sword of Damocles hanging over the whole company.
Absolutely. The PIF isn't a charity. Their commitment is deep. But if Lucid doesn't show real, meaningful progress toward efficiency by 2027, even the deepest pockets will start to look at cutting their losses.
So they have the money for the next few years.
Yeah.
But let's connect that back to the operational problems that make them need all that money in the first place. Production.
Right. Despite those 7 record delivery quarters, the hurdles are still there. We're talking about industry-wide supply chain issues, specifically for things like magnets, aluminum, chips.
And that's directly hitting their forecasts, right?
It is. They had to lower their 2025 production forecast down to 18,000 vehicles. The old range was up to 20,000. It's a small change, but it signals they're still not totally confident.
And we should probably mention the executive turnover, too.
Yeah.
You've seen a number of high-level people leave recently, which is never a good sign when you're trying to scale manufacturing.
That's a great point. That loss of consistent leadership contributes directly to the kind of inefficiencies we're seeing. And while everyone is waiting for the Gravity SUV,
The vehicle that's supposed to save them.
right, the company itself admitted that the production increase for the Gravity quarter to quarter was still unmeaningful.
Ouch. That's a tough word to hear when the Gravity is supposed to be the game changer. So does that mean the Air sedan is already yesterday's news?
I think that's exactly the strategic shift happening internally. And here's the silver lining in all this. Management now expects that sales of the Gravity SUV will actually outpace the Air sedan for the first time ever in the fourth quarter.
That is the Gravity shift, literally. So the market is already voting for the SUV, even if production is slow.
Yes. And get this, even with the loss of that federal tax credit we talked about, October deliveries for the Gravity actually increased from September.
So the demand is there.
The demand is there and it's strong. They just need to solve the manufacturing bottlenecks to meet it.
Which gives them the confidence to look even further out. Let's talk about their strategic long game, because they are not slowing down development. What's the pipeline look like?
They're planning way into the next decade. They have a mid-size crossover scheduled for late 2026. After that, 2 even smaller crossovers are planned for mid-2028 and mid-2029.
So they're going down market, building out a full portfolio.
Exactly. To compete with a much broader range of EVs.
But the most intriguing news, I think, and the deal that could really change things, is that partnership with Uber.
The Uber Technologies deal. This is a huge vote of confidence in Lucid's core platform technology. Uber is investing $300 million.
And that cash is earmarked specifically for developing a driverless service.
It is. But it's not just Uber and Lucid. It's a 3-way collaboration, and it points to a totally different business model for them.
How so?
Well, the service is going to integrate Neuro's autonomous driving system onto thousands of these Lucid Gravity vehicles.
Nero, the autonomous logistics company.
Right. And the plan is to launch a robotaxi pilot program next year in a major U.S. city.
So Lucid isn't just selling a car to Uber. They're essentially licensing their whole advanced vehicle platform, the chassis, the battery, the software, to be a key part of an autonomous fleet.
Exactly. It's a pivot. They're starting to monetize their fundamental tech, not just the finished luxury car. And the Gravity is the perfect platform for that.
Space, range, everything a robotaxi needs.
And that $300 million from Uber on top of the PIF money gives them a totally separate, diversified revenue stream, one that could be way more scalable than just selling high-end cars.
Okay, so let's try to pull all of this together for you, the listener. On one hand, you have these clear, impressive strengths.
You have the deep-pocketed PIF.
You've got 7 straight quarters of delivery growth showing they can build more cars. You've got strong demand for the new Gravity SUV.
And this shiny new $300 million deal with Uber that points to a whole new future. That's the upside.
That's the reason big investors are still hanging on. But then comes the reality check.
And it's a necessary one. You have to remember that Lucid, ticker LCID, is still a very high-risk, very volatile investment.
Why?
Because the sales volume is just way too small to get the economy of scale they need for profits, and they are burning through cash at an absolutely alarming rate.
As shown by that nearly 10,000% negative gross margin.
Right. They have the product, they have the partners, they have the money, but the operational execution is still the primary bottleneck. They just have to build it efficiently now.
They've seen that high executive turnover. They're struggling with production. I mean, the current cost structure is, frankly, unsustainable.
Precisely. The PIF and Uber deals bought them a future, a runway into 2027. But they still have to solve today's problems in the next 18 to 24 months.
That's the challenge, isn't it? Bridging that huge gap between their ambitious product pipeline for 2028 and the severe cash burn they're facing right now.
They have the time now, but they still have to execute perfectly.
Which brings us to a final provocative thought for you, building right on that Uber-Nuro partnership.
The entire focus of that $300 million deal is using the Gravity SUV platform for autonomous fleets. It raises a really fascinating question. Does the true long-term value for Lucid lie not just in selling luxury cars to people,
but in licensing their EV platform and their manufacturing capacity for future robotaxi fleets all over the world?
Exactly. What if they become the engine provider for these massive mobility companies? That kind of pivot could completely redefine the business model, and it might just provide the scalable revenue they so desperately need.